Bond yields hitting their highest level since the summer following Donald Trump's election win and just ahead of tomorrow's Fed decision. For more on where they might head from here, let's bring in Rick Rieder, BlackRock's Chief Investment Officer of Global Fixed Income. It's great to have you on such a huge day like this, Rick. Thanks for being here.
Thanks for having me, Scott. Big day, big night. It was a long night.
What's most on your mind today as you see all of these different asset classes rallying so heavily?
So it's pretty incredible. I mean, first of all, the results were incredible. It obviously raged on through the evening. But the equity market. I mean, this was, if you think about the growth dynamics that are going to persist. You know, economy that's been already operating at a good level. The growth data that's going to continue to be good. You know, the propelling of the equity market's pretty incredible. And by the way, I mean, beneath the surface, the drop in volatility that you're seeing is pretty. You know, I would say. Like you can own equities when volatility drops, you can own some convexity in it. So that's been super exciting today. Obviously, the dollar, and then the shift to the yield curve has been pretty extraordinary. You know, we've been talking about on the show before. The front end of the curve, while yields have backed up, it still is carrying really well. So that shift in the yield curve's been, I think, rightly so, steepening out quite nicely.
I mean, did we just pour gasoline on the bull market and throw a match on it? I mean, what has actually happened here within the last, I don't know, 12 hours?
Yeah. So, I think the last time we were on the show, I said I don't really like multiples, but it feels like we're long and we like equities, but it feels like speeding down the highway to try and get to where you're going. It doesn't feel great, but it's probably going to keep going. And there are two things happening that I think are profound. One, the technicals in the equity market are extraordinary. The amount of cash that's out there, and you don't really have any sellers. You don't have any IPO market, and the buybacks are profound. So you have an amazing technical. And to your point, what was challenging is the multiples are aggressive, and you have to count on, to get to the forwards on these multiples, you have to count on significant earnings growth. Well, you just got a kicker of maybe nominal GDP stays considerably higher. And by the way, I agree with the commentary earlier. You got to keep nominal GDP up, and that's how you outrun the debt. But maybe we keep nominal GDP up, and then the earnings, U.S. companies are operating leverage machines on nominal GDP, and so you just got a nice tailwind from that.
Well, I mean, it's good that you agree publicly on television with your boss. He's the one who wrote the piece.
Yeah, so I do. And by the way, it's just straight math. If you say today, so the average cost of debt in the United States about just under 3.5%. If we keep nominal GDP above 4 to 5, you can actually, and then you think about, gosh, there are things we got to do around spending. There's other ways to actually create spend that's got some velocity to it if it's spent on infrastructure, et cetera. If you create that paradigm, it's the only way that you can actually outrun the debt problem in this country. We got to do a couple things. We got to end up reducing the debt, the spend. We got to get the interest costs down, and then ultimately, if you grow fast enough, I mean, it's just straight math that you can actually. But it's the only way. I mean, quite frankly, it's the only way to do it. That's not a pernicious impact on the economy. This idea that we'll just aggressively cut spend, send the economy in a tailspin. It's just you don't get there.
Well, what do I do with the prospect of higher growth as we spin it now towards the Fed decision tomorrow and what policy is going to look like in 25? All of that obviously has the possibility of leading to protracted inflation, if not a pickup. So how should I think about, the idea that, maybe they're not going to cut even nearly as much as we thought because they're not going to be able to?
So here's the question. First of all, I think inflation, the descent of inflation has already happened. Like, we didn't think inflation was coming down much further or any further from here, no matter what. We think inflation is going to run in the mid-2s for next year. So we think the descent of inflation has come down. So if you're the Federal Reserve today, you think about, I mean, to me, it's a no-brainer in terms of, gosh, you got to get that funds rate down to 4. And if you get the funds rate, so you do a 25 in November, you probably do a 25 in December. Once you get the funds rate to 2, you got inflation at 2.5. And then there's a lot of policy evolution. There's a lot of things they're going to learn. And then you make a determination from there. I don't think it is that much of a challenge to get that rate down to a 4 level, which is still, I would argue, restrictive in many ways. But then it becomes, the question of do you execute the further cuts in the next year? And that becomes questionable. It's part of why I think the front end of the yield curve, which is pricing that today, it's like, wow, there's not a lot of downside in it. If you go further out the yield curve, and then you've got to count on inflation staying down, maybe the Fed cutting more, then it becomes a tougher trade. And again, why I think, owning 30-year treasuries, is a bet on term premium, bet on what we're going to do on the debt and the deficit, but you don't need to do it with the yield curve still as flat as it is, even though we've steepened somewhat.